Hello, and welcome back to another episode of Financially Speaking. I'm Kaylee Berenson with Bushka Wealth Management and Bushka Retirement Solutions. If you'd like more information on what you hear during our show today, please give us a call at 715 355 4445 or visit us online at retirewithbushka.com. While you're at our website, feel free to click on the radio page to check out past shows, and you can also subscribe to our program on Apple Podcasts, Spotify, and Amazon Music. In today's episode, we're going to be exploring the ever-evolving landscape of our economy, from inflation and interest rates to the broader trends shaping our future of investing. We'll discuss how global events and new policies, and also emerging technologies like AI, are influencing markets and creating fresh opportunities for investors. Before we get started today, I would like to introduce our co-host here. We have Logan Moeller, a fellow wealth advisor here at Bushka with us, and we have a special guest. We have Keith Gangl, a senior portfolio manager at Gradient Investments. Keith brings years of experience and a deep understanding of market trends and helping investors see the bigger picture, but also identify opportunities during the uncertain times. Keith, thank you for joining us today.
Thanks for having me.
Of
Oh, it's
course.
fantastic. I'm excited to do the show with you guys.
We're excited about this little bit different format as well. Little Q&A with Keith.
Yeah, it should be good.
Yeah.
Very excited as we move into the fall weather here too and everything.
It is
Mhm.
good.
Changing seasons, fresh start.
Right.
But let's dive in today. So
Absolutely.
I'm going to post some questions here for you, Keith. So
We're here to answer. If not, I think you'll entertain the rest of us. Anyway.
Yeah, I'll have to start doing some magic tricks or something here. But the first question that I want to pose to you is just relating to how do you see inflation, interest rates, and Fed policy really shaping the U.S. markets over the next 12 to 18 months?
Yeah, that's a great question. Those are all three key items in kind of what the markets are going to do, kind of the Fed policy, interest rates. Those are all intertwined. The Fed recently in September lowered the Fed funds rate, from 4.25% down to 4%. So that's kind of the question the market's kind of struggling with. What's the Fed going to do? Because as they cut interest rates, generally speaking, the stock market likes that.
Mhm.
Now, for your clients that are in retirement, it's not necessarily a great thing, right? Because usually when the Fed's cutting interest rates, that spurs the overall economy, helps growth, but also, it's not as good for the people that are retiring because if you have money in, CDs or money markets, generally you're not going to make as much. So that's a
Right.
key thing right now. And it's kind of a balancing act the Fed's in right now because, they're looking at the job stability. So they want to have full employment. Right now, we're pretty good. We're at about 4.3%. And the other thing they're looking at inflation. They don't want inflation going too high because when they start cutting rates, that could also peak up inflation. So there's kind of a balancing act going on right now. And the latest inflations are roughly around 3%, and their target is 2%. So again, as investors, we're watching all three of them. They're kind of all intertwined.
Yeah, I like how you bring up too on that conservative side. If you're in retirement, some of those CD rates, those things that we use or we call our green money tools start to not be the tool.
Not
but
as
they're
attractive as they were
exactly.
one time.
The good part is we have other tools that replace that. So that's the good part of it here.
100%.
Right. And you mentioned the Fed cutting rates. So what does the outlook look like for the rest of the year? Do we think they're going to cut more?
Yeah, and then there's a probability that we look at, it's a CME, the Chicago Mercantile. They look at and they do kind of the consensus where it is. There's the Fed meets again at the end of the month,
Mm-hmm.
and there's 99% probability that the Fed cuts another 25 basis points. So shocker.
Pretty high.
We're in the same camp that we think the Fed's going to cut another 25 basis points. And then the
Okay.
next question is, okay, there's one more meeting before year end. Will they cut again? And I think they probably will. Once they usually start these cutting cycles, they continue it. So I think we'll see 25 basis points. I think that's already baked into the market. Now, the next 25 basis point cut, that's a little bit more iffy. So I do think that generally speaking, I think things are slowing a little bit. So they want to make sure we have a little bit of extra insurance. So I do think they'll cut. Then the longer term question is what happens next year. I do think we're in this cutting cycle. We'll do 25 now. Even if we'd skip that 25 basis points for cut before year end, I think next year we're probably looking at another 75 to 100 basis points. So all in, we're probably looking at 100 to 125 basis points, which generally speaking is going to be a tailwind for the stock market,
Mm-hmm.
a little bit more of a headwind for, kind of that safe money as well. But there's all kinds of alternatives. It's something we're watching. It's data dependent. You always hear the Fed, Jerome Powell saying data dependent, data dependent. He's watching
Right.
jobs. Now, if the jobs kind of stabilize and inflation stabilizes, maybe we won't see those cuts. And I'm more in actually from doing this a long time, I'd rather see that where the Fed's not cutting to kind of spur activity.
Mhm.
I'd rather see the market find their natural place. And that's kind of where, people talk about this terminal rate. Where is the Fed funds rate going? I think eventually shakes out around 3%. So we're at 4 now. So that's 4 cuts of 25 basis points.
Okay. And you mentioned with the conservative investors, the CDs and the money markets. So how quickly do you think those rates will drop, after the Fed cuts?
Yeah, those almost one for one steps. As soon as the Fed
Okay.
cuts that 25 basis points, expect next time you go to get a CD, our money markets, they're going to
Mhm.
follow right along. Now, that doesn't mean, when we talk bond market, that's more tied to the 10-year treasury yield. So
Okay.
recently, when the Fed cut that 25 basis points, the 10-year treasury yield is about a little over 4%. And
Okay.
actually, since then, the last 3 weeks, the yield's actually gone up a little bit. So they don't go necessarily hand in hand, but those short-term money market kind of
Mhm.
CDs, that certainly will be impacted. The other thing that could be impacted on a positive thing from a consumer perspective is your potential car loans, things like that. They may
Mhm.
drop a little bit. Now, the housing market's more like the 10-year treasury yield. Ideally, if the Fed keeps on cutting, that would come down, and to some extent, that's true, but not always. It's also, strength of the economy, other things like that. So don't expect, that just because we're getting 100 basis point cuts for the next year, at least we expect that the mortgage rate's at maybe 6.5, 7% a 30-year. Don't expect that to go down by 100. We'd
Okay.
like it to,
Yeah.
because housing is a very important part of the economy. It drives about
Right.
15% of the overall GDP economic activity. So it'd be fantastic if it does, but just keep in the back of your mind, just because you hear the Fed cutting rates doesn't necessarily mean your 30-year mortgage is going to go down. We would like to see it go down, right, to kind of keep that activity
Right.
going.
Okay. Great.
Yeah, and some of the things that you just brought up there made me think about, like, are there specific risks when it comes from like the election cycle or global events or other things that you really look at and factor in when it comes to those investment strategies?
Sure. I mean, as far as election cycle, we always try to keep, our politics separate from our investment decisions. Generally speaking, it's whether you're left or right. We focus on company fundamentals,
Sure.
Okay.
but they do certainly have a short-term impact on it. And then right now, fortunately for us, we don't have to worry about elections for another at least a year plus, a little less, I guess, than a year right now. But investors, I would say, beginning of next year, will start pricing in what's going to happen in the markets. And it's a little too early to tell who's going to win, who's going to lose. Right now, obviously, the Republicans control all three branches.
Yeah.
At
Mhm.
some point in time, I would expect just the normal betting odds and history repeats itself. We'll have gridlock next go around next November,
Okay.
which generally speaking, from the backdrop of investors, like I said, we don't want to talk politics, but gridlock's generally a good thing. That's because no big policies are getting one way or the other, whether you like them or don't like them.
Mhm.
Nothing really happens. So companies can make their CapEx decisions based on status quo, which is a lot better than, things are going to change. I'm going to hold off on making this decision because of XYZ coming into politicians. So that's where we see. And then, geopolitically, anything can happen. The Middle East is always kind of like tenders are always burning over there. So something
Mhm.
could flare up, right? We just
Right.
don't know. Generally speaking, for the last several years, it's kind of been put on the back burner from an investment kind of, what considerations are. But there's all kinds of different things. Interest rate policy, I think the first question you let off, I think that'll
Yeah.
be definitely going to dictate kind of how investors are kind of perceiving what's going on in the market in the world. So that and tariffs, right? Tariffs are always something that,
Yeah.
we don't know what's going to happen. And we got the Supreme Court decision at some point in time, maybe this fall, that
Mhm.
whether they're legal or not, that opens a whole other can of worms that, that we'll keep an eye on.
Right, absolutely, and that is a great segue into the next question. So we're about 6 months into, Trump announcing the tariffs.
Mhm.
So what
Mhm.
effects have they had on the economy, both positive and negative? And you mentioned the legality of them, so are they legal?
Yeah, I mean, obviously, I'm not going to weigh into legality because I'm not on the Supreme Court. I guess
Right.
one of the nine will decide that, or a few of them anyway. It's surprising it's getting to this point. But first of all, let's talk about your original question, which is a great question. Tariffs have certainly been. We talked about, the Fed and the interest rate policy, but really,
Mhm.
what's kind of dictating the market direction for the last 6 months has been tariffs, the tariff policy.
Right.
If you remember, going back to April 2nd, Liberation Day is what
My
Trump.
birthday.
Yeah.
Whoa,
I
wow, you
know.
liberation.
What a day to be born.
What a day.
Right.
Wow, that's fantastic. A little
Oh,
factoid for
yes.
everybody out there.
Yeah. I'll
Mhm.
never forget your birthday now.
No, nor will I. April
Nope.
2nd is burned in everybody's his memory. But it
Sure
was a
is.
very, everybody knew that the Trump uses tariffs as one of the tools in his bag of changing policy. He believes there's a big imbalance between US trade and foreign trade. And he's right. And this is one of the tools he wants to actually kind of balance it.
Mhm.
And so what ended up happening on April 2nd, your birthday, he came out and announced that over the top aggressive tariff rates that no one expected. And if you remember, the market sold off very aggressively.
Right.
We were almost
Very
down
fast.
20% in a month, which again, I've been doing this for almost 30 years. We've had the COVID shutdown was 35% in 5 weeks. That was aggressive, right?
Mhm.
That's when the whole
Yeah.
economy was shutting down. And now it's like April 2nd, liberations, like these tariffs rates we never seen before. And it's just like the effective tariff rate, just as a whole, kind of what we were charging people as they brought their goods in, was about 2.5%. He came out with a plan that jumped that 2.5% tenfold to 25%. And the market's like, what is going on? It's
Mhm.
going to be economic chaos. Market
Right.
sold off pretty aggressively. So that was certainly a negative.
Mhm.
And I think people took a deep breath and, the biggest question was it economic chaos, which a lot of investors thought right away, or is it the art of the deal? I think a lot of people have come around to, again, Trump think it's art of the deal, trying to get some concessions. And that's kind of what the market kind of got a little comfortable with. And now look at, we're setting all time highs.
Right.
So I think the market's kind of, the effective tariff rate now, that 2.5 to 25%, we're in that 15 to 20. That's still
Okay.
a pretty big number.
Yeah.
Yeah.
And that number, well, you can talk about later about generating revenue for the government and what that's going to do. But so that's a big number. And I think the market's comfortable with it. And then it
Mhm.
rolls into your question about legality. Now, what happens if these are rolled back or say they're illegal? I don't know doing this a long time, that's going to be a strange game. And I think it could cause another little, as much as the market didn't like them at first,
Mhm.
the fact if they get overturned, I think we could see another negative reaction, which is weird. You're like, you told me you didn't like them at first. We sell
Right.
off. Now it's like market's
Yep.
comfortable with them and now they're illegal.
Mhm.
They're going to sell off. But I think what would happen then is the Trump administration is pretty creative. I think they'd find other ways of applying those tariffs back. So
Okay.
I don't think they entirely go away. So I think that's in the
Mhm.
back of a lot of investors' minds as well.
Got it.
Yeah, and I think expanding on that too is we get a lot of questions in the office all the
Mhm.
time about like what these tariffs are, but expanding on like who's paying for what with these tariffs
Yeah.
and the
Yeah.
revenue for the government. Like, just could you expand on that a little bit? Like, just like what the
Sure.
outcomes are?
Another great question. I always like to, I do quite a few of these presentations, talk about tariffs, and everybody hears, especially on April 2nd, your birthday, everybody's like, how bad these tariffs were going to be. And again, tariffs are a tax. That's factual.
Mhm.
But it's just the question of who actually pays the tariffs. And the media basically assumed the tariffs, and I think some companies as well, that tariffs are bad. They're taxed. The consumer's going to pay them. That's part of who could pay them. There's three people: that the importer, the foreign kind of entity, the government, the company that's importing it, the company that's actually buying the imports. That's actually when the tariffs get paid, by the way. It's when they come into the US customs and they're
Okay.
collected there. And then thirdly, the customer. So one of those three parties are going to be paying these. It's just a matter of who. Right now we're 5 months plus into, again, these are rolling tariffs, right? So
Mhm.
we're
Mhm.
about 5 months into it, and the first studies, the stats that we've seen so far is about 25% of that tariff amount the consumer was paying. Another 50, almost 60% was the U.S. companies that are importing them,
Okay.
and then the balance was the foreign. So actually, the consumer's not hit that bad. 25% is not too bad, but obviously, I think what's going to end up happening, they'll get more of that burden. So they haven't quite seen it yet. So it hasn't
Mhm.
impacted the stock market yet. But that being said, if 60% is eaten by the U.S. companies, that was going to play out in their margins, right? If they can't sell something for $100, now they sell it for 98,
Mhm.
and their costs went up, they're going to have less margins, which means less earnings growth, which means less valuation. So it's kind of a big circle. So it certainly is a tax. It's just a matter of who pays for it. That's what everybody's got to understand. So I think in the end of the day, it's probably going to be something like, I don't know if it's a third, a third, a third. Depends on what you're
Yeah.
importing. If it's something that we can't produce here in the US, it's probably going to get passed on to the consumer. Now, if the importing company can buy it from somewhere else, maybe that doesn't get passed on to the consumer. Maybe it just negatively impacts the foreign trade. Now, your second part of the question is another thing that I think is unintended consequence on the positive side for the government is the revenue it's generating.
Mhm.
Okay. Yeah.
So just in perspective, I'll throw a lot of numbers at you, but last year, the U.S. Customs, that's where they collect the tariffs, they collected $77 billion. Big number, right? Which
Mhm.
is about 1.6% of the overall U.S. income, right? So we get about the U.S. federal government income. They get about 50% from income taxes. All of us at the
Okay.
table paying income taxes. Another payroll tax, I think it's a 30%. Corporate taxes, you always hear about corporate taxes. That's only 10%. So, and then these tariffs are 1.6%. Now, what we see in the last couple of months, we're starting to see these tariffs actually getting applied. Last month, in July, last day we had was $30 billion in 1 month. Remember last year we did 77,
Oh
1 month,
wow.
30 billion. The previous month was 28. So we're on a run rate from between 400 and 500 billion dollars. That's a big number. And so
Right.
our budget, that could be 10% of our revenue coming into the government. Now, do you think with the government situation, how they like revenue, you think that's going to go away anytime soon? Doesn't matter what party is, in my opinion, because if 10% of your revenue is getting generated by tariffs, I don't think they're going away. It's kind of, we like to say in you guys are a little younger than Tony and I, but
Well, thank you.
yeah, so it's, back if you want to book an airline ticket years ago, it's like you bought a ticket, that was all you paid, right? And then
Mhm.
all of a sudden, unbundling happened, right? You want a seat on that airplane. Okay, that's gonna charge you extra. Oh, you want to bring some bags. Okay,
Right.
that's gonna cost you a little extra, right? So it's like I think that's what's gonna happen with these tariffs. It's newfound source of revenue for the government. So even back to your original question about elections, what happens next time? I think these tariffs are in place. Now they could
Mhm.
change it a little bit by how much they're gonna be, but if you go back to Trump 1.0, his first time he had tariffs as well against China was 10%. That effective tariff rate went from 1.5 to 2.5%. Biden's administration, they didn't change them, kept the same. They actually added a little bit. Just to keep that in perspective, not talking
Okay.
politics one way or the other, but I do think these tariffs are going to be here for a while, and they're
Mhm.
going to be a meaningful impact to the overall revenue going into the government.
Yeah, absolutely. Wow, a lot of good information there.
Yeah, it's a lot. That's a long
Right.
answer for a fun
Yeah,
subject.
Yeah, hopefully you're taking
absolutely.
notes out there.
Right?
That's good information. Thank you.
So when we talk about the job market, it seems like it's softening a little bit. How do you see that playing out?
It is. I mean, like I said, it's like one of the key factors is the monthly data, and that goes back to, we I'm sure we'll at some point in time, the government shutdown is so we're not getting government data right now. We just missed the last data point of,
Right?
so one of the
Mhm.
things in the shutdown, you don't get government data. So it's like we don't know where unemployment is.
Mhm.
The previous month was at 4.3%. If you look at the chart of that for the last 6 months, that's been ticking up from, high threes to 4.3. It's still pretty much 4.3, low fours. That's still full employment, unemployment, but it's something we're keeping an eye on.
Mhm.
Because it's again, back to your original question, the Fed policy, one of the mandates is full employment.
Mhm.
4.3 is still pretty sticky, but if 4.3 goes to, say, these tariffs, these are all tied, these subjects, right? Tariffs start to impact consumer, they spend less, people get laid off. Maybe that 4.3 is going to 4.4, 4.5, 4.6. Just so you know, last 25 years, the median number is 5.1% of unemployment. So we're still quite a bit
Okay.
below the 25. You take a step back. We always like to take bigger pictures, not just
Right.
what's happened recently, right? So
Of course.
we're still pretty healthy. That's why we're positive. And then the one other takeaway that I always talk and I always like people to remember is there's no one that can spend like the U.S. consumer. So if the U.S. consumer is working, they have money in their pockets, they will absolutely spend everything they have, which is great for the economy, great for the stock
Right.
market. Maybe not great for their savings accounts, but
Yeah,
they
burning a
can
hole in their
spend,
pocket.
burning a hole in their
Yeah.
pockets. So at 4.3%, it's still fairly healthy, but it is kind of slowing down. And that's why we have earnings season here, come up here in a couple of weeks. We'll be keenly listening to what the companies have to say if they need to starting to, maybe shed some employees or not hire as much. So
Yeah,
definitely keep an eye on that.
absolutely.
Of course, and all good information. So thank you so far. Moving more into the investment side of things when it comes to different types of investment strategies. How do you recommend looking at a growth versus an income strategy in today's market based on everything we just talked about?
Yeah, so certainly you guys do a fantastic job with your clients of allocating them, having, first of all, a diversified plan and everything's customizable, right, to their needs and objectives, which is very important. You guys do a fantastic job working with all your clients. So I can't emphasize that enough. But so how we look at it, with interest rates, again, back to that first question of interest rate policy, that's going to dictate what bonds do.
Mhm.
Remember,
Mhm.
when rates go up, bond prices go down. If we go back to 2022, that's when the stock market was down almost 20%, a tough year,
Yeah.
and bonds were actually down 13%. We don't ever see that. And that was that 2022 inflation, that, remember that whole inflation
Oh
thing
yeah.
spiked to
Mhm.
9.1%. I think it was in June of 2022. So we had a huge spike in inflation, which then caused the Fed to start raising the Fed funds rate, which all of a sudden then, yields go up, bond prices go down. Just a terrible environment for a bond investor. So we were
Right.
recommending back then, is like, we didn't know inflation was going that high. Is like, that's not a place you want to find some alternatives to bonds.
Mhm.
Right now, the way I think a good allocation is stocks and bonds, I think, are more in that normalized market. So when I talk in bond market, you can generally, that 10-year treasury yield, that stat I threw at about 4%. That's still pretty good, return for your investors that are retired or just 4% is not bad.
Yeah.
So I think bonds going to do its thing. And like I said, if interest rates, the Fed cuts, you can expect, remember, when Feds cut down, that means your bond prices go up. So I think that's where, if you get that normalized return of 4 to 6% on a bond market, that's pretty good. And then the stock market, I think you still want to be allocated to it. I mean, there's so many fundamental reasons that, markets are still strong. The employment situation, earnings are good, valuations a little stretch, but I still expect that kind of that normalized year of 8 to 10% when we kind of start forecasting out. And again, what ultimately dictates the stock market, you know, ability to go up, I think, is earnings growth rate. And we're now getting into earnings season, which happens 4 times a year for several weeks. And us as portfolio managers are super busy just analyzing all these different companies in the S&P 500. What's happening? Is there a change in policy? Is tariffs kind of flowing through finally? It's because it hasn't really impacted companies yet. Maybe it will. Then you have to start changing your projection. Then all of a sudden, maybe your earnings growth rate, instead of going 10% next year, is now 8%. So stocks are less valuable. So then you have to start reallocating your portfolios, become more defensive. You as allocators to say, okay, we've made some good money on these portfolios. You're a 60-40 client, means 60% stocks, 40% green safe money. We need to, maybe with the market appreciation the last 2 years, you're at 70-30. Come review time, you're looking at, I was like, we're talking to our investment management team. Things are kind of expect normalized, but maybe 70-30 is really not your risk profile anymore. You should rebalance. In that case, you'd be rebalancing, selling some of your stocks, buying some of that green money stuff like, bonds or FIAs or whatever it may be. So those are kind of the allocation decisions that need to be made.
Yeah, absolutely. Where do you think the best opportunities are when it comes to U.S. equities right now? So between large cap, small cap, tech, healthcare, energy, all those different sectors. Where do you see those opportunities?
Yeah, that's a fun question. Like I said, I think the setup is what's driven the market the last couple of years has been the large mega cap growth names with AI revolution going, or evolution, however you want to look at it. That's certainly driven the market. Those mega cap names are now, I think the top 10 or 35% of the overall market, which is the S&P 500. So that's a big driver. So anytime those 10 names move with their good earnings, that drives the market up. So I think now we're into the phase that we've seen a lot of good performance on there. I still want to be involved in those kind of names. Certainly don't want to be just, if you have 35%, you don't want to be going down to 10 and saying, no, I'm going somewhere else. But I do think there's an opportunity for the market to start broadening out in different plays like that. So outside of technology, there's stuff like industrials and healthcare, small cap. I think those are all areas that we're looking at, and that we're incorporating that into our decisions when we manage all the different portfolios we have. We're looking at that instead of, okay, focusing just on the tech names. We want to, let's trim some of those nice profits we've had in some of these names, and we'll maybe buy some healthcare, maybe buy a beaten up name somewhere else, maybe buy an industrial name that's levered to the AI build up. Maybe it's a equipment name, maybe it's some kind of utility name, maybe it's a lighting name. There's so many things when you think about the AI build out besides just the technology names that performed really well. Like obviously the one that everybody talks about AI is NVIDIA. That's the first, because they're the chipset that make it all possible. Stock's been a home run. It's the largest market cap in the world. It's been a fantastic company. Now, do I think it's gonna start, selling off aggressively? No, but I do think there's other opportunities as well. So I think you still want to be involved with a name like that, but then look for those other second, third ways of playing the AI revolution. It's still going to be there. And there's other things that are working as well. I think small caps haven't had their day for a while. International, which I know you guys like, and it's been a good call. It's international markets are starting to perform. They haven't worked for a decade,
right? Or longer.
No,
yeah.
or longer.
Making a comeback.
We're making it. And this year, I think, roughly, when we're through Q3, rough numbers in the SP were about 15%. International markets were around north of 20, 24, 25%, depending on which market you're looking at. So they've had an outperformance by about 10% to the S&P. So that's a big,
huge,
big move.
Well, I think that just goes back to the old saying that we've heard a million times, is don't put all your eggs in one basket.
Absolutely.
Yeah.
We need different baskets to put different eggs in. Right?
No, and you guys do a great job of diversifying your clients, and it's fun to work with you, and how you walk through that process of, okay, this may be the hot market, but we don't want to be chasing the hot shiny object either, right? Because you want to also, international starts to work. Maybe bonds start to work. Maybe some sectors that we haven't looked at in the past start to work. Small cap could be one of them that I think you want to. As a portfolio manager, those are all the areas within the portfolios I manage. Those are areas that of interest to me that, I think they're maybe on sale relative to some of the more expensive parts of the market.
Right. Absolutely.
Yeah, and it kind of answers already, but I do want to ask the direct question of how should we think about AI and tech exposure without being over concentrated just into one space? Like you talked about, AI is that buzzword, but there's more to it than just the AI chips.
Oh, for sure. And we touched on it a little bit here with the fact that, the leader in the chipsets has been NVIDIA, but there's now competitions coming to the space. They're not the only player in the AI space. It's got Broadcom. There's other names as well that are competing there. There's a lot of tech names. That's the kind of the first go-to when you think of AI.
Mhm.
And I think that's not played itself completely out, but I think you're more, if the baseball analogy, you're getting more in those later innings of that massive outperformance. Doesn't mean that they're going to be bad, but there's certainly some opportunity for that next layer of companies to actually start performing. And those are some of the names like I mentioned to you, like a company that does even like building transmission lines. Not a very sexy business, generally
Right.
speaking, right? But it's
Right.
like, oh, they're making a lot of money. All this data center build out we're talking about. The CapEx that these mega cap names are throwing out is just massive. And I can't emphasize that enough. And that's why I do think that you still want to be involved with these mega cap guys, because they are throwing so much CapEx. They're going to get this AI to work. And the small players historically that used to be able to compete on the tech side, they just won't be able to pay up for those chipsets and those other things, that infrastructure. But a way of playing it outside of that is, like you said, how about a lighting company? It does all the lighting, all the power supply, right? The thing about AI, it consumes so much energy.
Hmm.
That's one thing we got to keep an eye on. And that could change. I mean, we saw, it seems like a long time ago, like DeepSeek came out and basically,
Yeah.
I remember that shudder. All
Yeah.
of a sudden,
Yep.
technology just got rattled for a few weeks,
Hmm.
and all of a sudden, the investor like, oh, ho hum, that's not a problem. But it's like
Right.
that could come again where there's some other form of that, and all of a sudden, it's going to scare the markets. And it's again diversification. Don't put all your eggs in one basket, because I do think AI is here for real. It's not going away. It's making people more efficient. I'm sure it helps you guys perform your jobs, helps us. There's certain things that you wouldn't want to be going, like a call center, like a person in a call center. Like there's
Yeah,
stuff that
Always
changes,
frustrating.
for
right?
sure.
Right?
Yeah.
This AI, how much better it's going to be. Like an editor, we do a lot of commentary pieces, and we write it, and then we usually have one of the other portfolio managers look at it and edit it. It's like,
Hmm.
well, now we can write it, throw it through an AI editor,
Right.
comes back in minutes, not hours or a half a day, right? It's like, and that saved that person the other time of having to do it. And it's like, that editor is pretty good, just so
Yeah.
you know, not too bad. So, but
Pretty
there's
efficient.
pretty efficient, and those are just simple. That's why I do think AI is here, and that's why those
Hmm.
large tech companies are spending so much money. If you asked me a year ago, would that much money being spent in the space, I would have said no. I would have said that we're kind of tipping out, and Nvidia could be rolling over a little bit by now if I would ask me a year ago, just because competition or CapEx slowing. That
Hmm.
hasn't happened. At some point in time, it will. So that's why, again, we diversify as well within our portfolios.
Absolutely. I think we have time for one last question. So, in regards to AI, still, are the markets in an AI bubble?
I don't think they're in a bubble, but I certainly do think the key word we've been talking about for the last several questions is diversification. Make sure
Yeah.
you stay involved with these big names. Again, NVIDIA is so large, it's hard to ignore them. So as
Hmm.
an investor that, I manage a portfolio that broad base, you certainly want some exposure there, but
Hmm.
maybe as it's performed so well, you kind of trim it back and you start buying other names that are maybe haven't performed as well. Other themes that are going to come out too, like healthcare has been an area that, you and I have talked, Kaylee, in the past, that
Yeah.
it's been an area that's been really beaten up. I think
Hmm.
that it's underperformed, low expectations. And it's just
Yeah.
usually something like that is also, oh, valuation's interesting. And also maybe have a new product. Maybe the government's less stringent on some kind of, prescription medication or whatever
Yeah.
it may be.
Hmm.
Those stocks can have some big moves pretty quickly. So that's
Create some opportunities.
create some opportunities. And there's
Yeah.
industrial names. Like I said, there's all kinds of different ways when, the market's got 5,000 different stocks. There's a lot of different opportunities. So it's like
Absolutely.
there's been a little bit of a rolling kind of recession in certain parts of the economy.
Hmm.
Tech is kind of the big tech's kind of hidden some of that. And I do think those names that are kind of underperformed for a while, those are areas that we like to look at to see for an opportunity when you look out the next 12 months when we invest.
Absolutely. All great information. Thank you so much, Keith.
Thank you.
Before we wrap up today's episode, I just want to quick mention that we do have our women's group hosting an exciting event. We have our Breaking Financial Barriers brunch coming up on October 25th. That's going to be from 10 a.m. to 12:30 p.m. We have Lisa Schreiber joining us from Gradient Investments, and she's going to be sharing some tips on empowering women financially but also giving a quick market update. There's going to be a brunch, mingling, and some fun prizes, something that you don't want to miss. So, ladies, get over to registration. It is open now. You can register at empoweredbybushka.com. So, go there, check it out for more details.
And thank you for tuning in today's episode of Financially Speaking. Listeners can visit our website at retirewithbushka.com or call our office at 715-355-4445 to discuss how we can answer your questions and address any of your financial concerns. Thanks.